In this video, we'll explore three key inventory valuation methods. Let's dive to the first method, first in, first out. This method assumes that the first items purchased or produced are the first to be sold or used. This method allocates the earliest cost to cost of goods sold, while remaining inventory is valued at the most recent cost. Key point reflects physical flow of the most inventories. So in this method, the company allocate the stocks that purchased in the past, starting by the old items. This method, FIFO, is accepted by all the accounting standards like IFRS and US GAAP, and it provides more current cost for ending inventory. We go directly to see an example. We need to calculate the cost for 45 items using the FIFO method. This is our purchase. This is the date. In May, we purchased 4 quantities with a price of 15. Then second purchase with a price of 14. Then the items with a price of 17. In order to calculate the 45 items to be used and considered as cost of goods sold. So we start by the first items. We look to the first line. We have 40 items. We calculate 40 multiply by 15. As you can see here, 40 items are priced as 15 each. Our calculation, 40 multiplied by 15. Now we have 5 remaining because we said that we have 45 to be used. We go to the price for the second item, which is 14, and we get 70. So the total cost will be the price total cost for the first part, 600, then 5 multiplied by 14, 70, and we get the total cost is 670. This is the amount that will be shown in the cost of goods sold, and our stock will reduce with this amount. Second, last in, first out. This method assumes the most recently purchased items are sold first. Cost of goods sold impact. Most recent costs are allocated to the cost of goods sold. Usually when we purchase stock in the past, the old items purchased with lower costs. The recently purchased is paid. It costs more because there is inflation, there is price increases. We go directly to the example, the same example that we have seen before. So in this case, we start by looking to the last items. Here we have 30 multiplied by 17. This is the price that we calculate for the 30 items. Then move to the second part. We calculate the remaining, which is 45 minus 30, and we get 15 items that we purchased with a value of 14, and we get the addition for the first line, then for the second line, and we get a total cost of 720. This is the method how we calculate our stock according to the LIFO method. That's some consideration when using LIFO method. So IFRS LIFO is not permitted in the international financial standard and is allowed in their US GAAP. And companies must adjust for LIFO when reporting internationally. So when there is reporting for such company, if the company use IFRS, then they need to report under US GAAP, so they need to adjust their financial statement, and the opposite. If the company they use US GAAP, then they need to report their financial statement based on IFRS. So in this case, they need to make adjustment to meet the standard that they are following. The third method, weighted average method. This calculates sum of the cost of all units available for sales. In this method, we calculate the sum of all the items that are available for the sales. Then we determine the average cost, which is by dividing total costs by the number of units that we have in our stock. Then we apply it to the inventory. when we use the product. So we use this, the average cost multiplied by the units that we need to use to get the amount of the cost of goods sold. We will see the example, the same example that we have seen before. Here we need also to calculate the stock for 45 items sold. So this is our example. We have the same purchase. This is the initial purchase. This is the first purchase with 10 multiplied by 12, and we get 120 as the total cost. So the total stock at the end of this period is 10. This is the cumulative value. Then the total cumulative value for stock is 120. Our weighted average cost is calculated by dividing 120 by 10, and we get $12. We move to the second items, the second line. We purchase 40 items with a price of 15, and we get the total amount of the purchase for this period is 600. Then we calculate the total cumulative items that we have available items at this period. So there is 10 purchased the last time plus 40 that we just purchased, and we get total items in stock for 50. Then we calculate the total stock value, 120. That's mean what we had in our stock in the last period, plus the total purchase for this period, 600, and we get the total of 720. To calculate the weighted average cost, so we need to multiply 720, that's mean the total stock value, by the total stock, 50, and we get 14. Then we move to the third line. We have another purchase for 20 with a price of 14. The total amount is 280. The total stock is the addition of 50 plus 20, and we get the total stock of 70 items. Then we calculate the total stock value, which is what we had in the last period, 720, plus the total purchase, 280, and we get the total stock value for 1000. Our weighted average cost is 1428. We get this value by dividing 1000 by 70 items. Now we come to the stock exit, to our calculation. So we need to reduce 45 items with a price of 1428, which is the price that we have in, which is weighted, which is the weighted average cost that we have at the beginning of the period, which is 1428. And we get the total cost, 642.6, which is the total cost that will be shown in the cost of goods sold. And this is the amount that will be reduced from the total value for stock. The total stock will be 70. That's mean what we had at the beginning of the period, minus 45, and we get 25 as the total stock at the end of this period. Then the total stock value will be 1000. That's mean the price, the total cost that we had before selling these items, minus the total cost for 642 US dollar, and we get the stock value become 355. Then we calculate again the WACC at the end of the period. It will be 14.3 US dollar. This is the total cost that will be shown in the cost of goods sold. Finally, let's compare the three different methods. The first method, we get the total cost for 670. This method assumes the oldest inventory is sold first. Then LIFO method, last in, first out, the cost is higher than the the first method because the new price is higher. We purchase our stock at the beginning with a value of 10, then increase by the time. Then the weighted average method is 642, which is the average price for all our purchase for the last period.